Remember this? Okay, this is the S&P cash. This was this ascending channel that we're above the 8 day the entire time. Okay, right here, you see this 8 day? These 2 days, it broke. Okay, remember here, when it broke the 8 day, that was like a month before. Well, on that period, I also reduced some risk because look, we were above the 8 day this entire time. Okay, above the 8 day, above the 8 day, and the 21 day if you want to be even a little less active or less exact. So riding it this entire time, finally reduced some position, gap down, filled the gap so it didn't show that the market had so much downside power. Then it reclaimed it again. Okay, and I got back into positions once again. Here, loose and wide, okay, broke the 8 day, came back above. I don't know if you guys follow me on Twitter. I was actually at the beach on that Thursday, or it might have been Chase was taking a basketball lesson, and I had 20 positions on. I got stopped out of like 7. And then it also came back at the end of the day. I'm like, oh, wow, okay. I got stopped out of 7 positions. Now I'm down to 13 positions. Then all of a sudden the next day, remember I was sitting on the chair doing a Twitter video on Periscope from Miami saying, guys, I'm down to like 5 positions. We're below the 8 day. I think this is when I tweeted this at you guys. I'm like, hey, lots of momentum levels broke in key names. Amazon broke 21.25. Okay, that's when I got out of it. Apple broke 315 to 317. That was important. Netflix closed below 380. Remember, we were trying to play it above 393. Google broke 1504, and the S&P cash broke 3342. This slide, I also, by the way, every now and then, because of Redler All Access, I take the slide from Redler All Access and I post it in the public. That Friday, I posted this. I said, hey guys, take notice. It's time to play, what did I say? Big time defense, not aggressive offense. After an 11-year bull run with the complicated headlines, you have to adjust as a professional trader. You have to switch gears if you trade for a living. This slide, along with this, told you you had to get careful. And anyway, this was 32.14. So now, here we are. You go back to this spot. Okay, look where we are. If you did not sell when we broke the 8 day, and that's when I probably went from 20 positions to about 5, all of a sudden you had a gap down. I remember this was a Monday we had that gap down, huge gap. Another thing I incorporate is when you have a big gap down, okay, the way you judge the power of the gap down is whether it gets filled or not. If this does not get filled, okay, if this does not have people buy because we're on sale, it shows you power. So here's 32.14. Here's the prior low from the day after the gap, 32.14. So a break of this, if you didn't get out on these 2 days or here, that should have been your confirmation sell. And I know 32.14 isn't 33.50, but you know, it doesn't matter. That's when the trade continues to change, and that's when you have to continue to switch gears. So again, this was 32.14. And then again, right there is your momentum lost and your key levels. And then take a look here. So this is when the 21 day broke, which I went over in my moving average books. This is when you had the gap down that didn't get filled. Here's when you confirmed it by breaking 32.14. So if you didn't get out on this day, I know it was painful to get out here of whatever positions you were in. Some guys actually press shorts here. But 32.14 wound up going all the way down to 28.55. So if you sold it here or waited till here, you did a lot better than getting crushed down to 28.55. And this is only the S&P cash. Imagine what stocks were doing. And look at this, and now it's below all the moving average. And then here, all right, guys, I talk about the 200 day. First time, usually you break below it. Then you come back above it. And then here you're now below it. So if you guys remember, my 200 day moving average rule is if you stay below it and you cannot reclaim it and show power after 4, 5, 6, 7 sessions, that's your confirmation that institutions are getting out of the way. That, you know, below the 8 day, yes, as professional traders, we get out of our momentum loans, we get tactical. Here, below the 50 and the 200 day, you know, you have to get out of some investments. You should not be investments in individual names below the 200 day besides sectors. Okay, that's another rule. And that's, again, I'm not being an economist. I'm not talking about coming out of Harvard or Yale. I'm talking about my technical approach in the ebook that I sent you guys back in January. So anyway, now you're below the 200 day. So this is another spot to adjust. And if you remember on this day, I was like, hey guys, you know, I think I bought the VIX. I bought 300 puts. I'm like, why wouldn't we test 28.55. Remember that? Remember that. This was one of my best days actually of that month. Okay, and it was short. Yes, everyone, Red Dog, you're a permable. No, I'm not. So right here, I was long the VIX at 27s, 29s, 32s, 33s. I haven't tweeted that out. Guys were calling for accommodation here from the Fed. I'm like, what are you guys talking about? We're 12 to 14% off the highs. We didn't even retest 28.55, and you guys are calling for stimulus. And we're 12 to 14% off the highs. And, China's closed. Italy's in shambles. It's spreading through Europe. We're not even, looking at it here yet. So PS, that was your next spot to adjust. And if you did so, you saved yourself a lot of pain. That's right here. And then look, 22.80. So look at this. 8-day moving average below the whole time. It just, gap doesn't get filled, breaks below 32.14. You combine confirmation of the weakness. We were doing this all in the moment. None of this is hindsight. None of this is 2020. I am teaching you this. I already taught it before, and I traded in the moment with Redler All Access and the VTF this entire way down. Okay, and right here, we were in the 300 puts. We were in the VIX calls. So into this move below the 28.55, it's probably my biggest day in the last month or so. And now we've been trending all the way down. And look where we are, below the 8-day moving average, not above when we're in a healthy market. In a market when anything could happen, a market where you have to be really, really careful. Complicated times that we've never really even witnessed before. So now, some people are like, okay, what do we do now? Or how could the best names in the energy field, be so bad? I'm like, what are you talking about, the best names in the energy field? Look at the XLE. The XLE was below the 200-day moving average pretty much, if you look at this, for months. 200-day below, 200-day below, went above for a second. So even if you bought it for a second, got faked out, who cares? Still better to get out of the way. So this was below the 200-day, which was at $50, well before this massive decline. Energy names were not healthy. Energy names were broken. Energy names should not have been in your portfolio. Now, energy names are definitely an indicator for sentiment. So you have to watch the XLE and have to watch oil. Anyway, but at $60 is when the XLE was no longer investment quality. And then if you trade with the 821 day, you could have been short every time it came up there and failed. What else? The banks. I was long the banks a lot during this time period, okay, when it was above the 821 day. And then finally it broke. If you didn't get out here, okay, but then you had a chance to get out of the 200 day. The 200 day was 29. Now look where it is. It went all the way down to what? Below 20. So what could you have seen here? You could have seen A, we lost momentum below the 821 day. B, you had a gap that didn't get filled. C, the 200 day was lost. You get out of the way. And now you have to watch the banks every day for sentiment. Okay, and then what happened? What else has been a problem spot? The Jets. Oh, look at this. Into resistance, look good, and then what? Broke the 821 day and 200 day pretty much all in one swoosh. So if you got out, followed your rules when this was below 30, this freaking thing went to $12, 11 and a quarter. You could have got out of 30. You didn't have to get out at the top. You could have got out here or even here. Or remember, you draw a line here, which was support going sideways. And then what is it? Below the 8 day this entire time. So many ways to have saved yourself so much money and made yourself so much money by not having opinions and using just your moving averages with the tier system, with your risk tolerance, with your sizing the whole way. Okay? And then everyone's now talking about Boeing. Oh my God, Boeing, after this happens, one of the biggest, best companies in the world, name renowned. Okay, it was a problem since 336. Here, before the whole coronavirus, you had a break below the 200-day and the 821 day. That was at 360. Oh my God. And then here, yes, you might have got faked out. Okay, but what did it do? All it did is it tested 200-day before breaking and then breaking 300, and it went all the way down to 89. What? Following below the 8-day moving average. Okay, here it was a little bit above before it broke, tried it again, broke, this time broke for good. So by using your moving averages, A, you wouldn't have been near the financials, the airlines, or the energy names, no way, below the 200-day. And then if you were using the S&P for your composure, whether you were in portfolio approach or tactical approach, which we mentioned up here, you could see there were so many different ways to get out of just to adjust. And that's what we do as traders. We adjust.